Happy Saturday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's #2 economy. My name is Tony. Let's jump in. And we have some fairly incredible news to cover in today's episode, which will largely be focused on the Chinese economy. China's $11 trillion government bond market is showing unprecedented signs of pessimism, as this week yields on 10-year sovereign bonds plummeted to record lows, creating a 300 basis point gap with the US counterparts. China's economy faces sluggish growth and chronically low inflation. Regular viewers know this, of course, starkly contrasting global trends of rising interest rates due to inflationary pressures. Long-term interest rates in China have plummeted to record lows as investors increasingly shun riskier assets like stocks and real estate in favor of bonds, a sign of deep pessimism in the economy for the foreseeable future. The decline underscores deep concerns over China's economy potentially sliding into a deflationary spiral akin to Japan's lost decades of the 1990s and 2000s, with one Hong Kong bond trader dramatically expressing this week that this is it, China's done. While this may prove to be a little over the top, the situation is pretty bad. Despite recent stimulus measures, including efforts by Beijing policymakers to spur domestic demand, investors remain wary of whether China can avoid prolonged economic stagnation. The 10-year bond yield recently dipped below 1.6% for the first time, falling far below levels seen during the 2008 global financial crisis and the COVID-19 pandemic. Richard Koo, chief economist at Nomura Research Institute, speaking to US-based Bloomberg this week, observed, quote, "If the bond market is right, the implications would be profound." End quote. He described the situation as a, quote, balance sheet recession, end quote, where both households and firms simultaneously prioritize debt reduction over spending, stifling economic growth. The similarities between China's current predicament and Japan's deflationary struggles are striking. Both countries experienced a real estate crash, weak private investment, tepid consumption, and an aging population. Investors are increasingly looking to Japan's experience for insights. Although Beijing has rolled out stimulus measures and declared its determination to stabilize the currency, analysts argue that these actions are insufficient. Weak consumer confidence, an unresolved property crisis, and a lack of robust policy measures are suppressing inflation and fueling fears of long-term stagnation. Some experts remain cautiously optimistic, noting that China's situation differs from Japan's. Wang Yingrui of AXA Investment Managers, for example, suggests the country is experiencing a, quote, partial balance sheet recession, end quote, mitigated by the government's spending power. Notice, though, even this optimistic outlook admits that there is a partial balance sheet recession. Others highlight emerging industries such as electric vehicles, which could help China transition away from its debt-driven growth model. However, as we've explored in previous episodes, some economists and analysts have pushed back heavily against this argument. And still, the clock is ticking. Data shows China's GDP deflator, the broadest measure of economy-wide prices, is at its longest deflationary streak this century. Meanwhile, consumer and producer prices continue to hover near zero. Indeed, it could be much worse. As US-based Rhodium Group recently noted in a report we covered a few days ago, quote, economists associated with China Finance 40 Forum, a think tank, recently argued that consumer price index, CPI growth, over the past 3 years was around -2%, well below official figures. End quote. Analysts warn that delayed action could worsen the crisis. Xin Yaoying of ABRDN PLC told clients in a note this week, quote, it's a downward spiral that will keep getting worse if it is not corrected. End quote. Moving to the next development, then on Friday, in a striking sign of the Chinese economy's stagnation, the central bank said that it had temporarily stopped buying government bonds. The central bank's unexpected action is aimed at breaking a recent shift by investors toward purchasing bonds, which have driven China's long-term interest rates to a record low. This is quite the move and is a huge red flag. It marks a departure from typical monetary policy responses during periods of economic weakness. Chinese households, wary of plunging housing prices and volatile stock markets, have channeled unprecedented amounts of money into low-interest savings deposits with banks. However, commercial banks, unable to lend these deposits effectively amid weak business confidence, have resorted to investing in bonds. The People's Bank of China's pause in bond purchases aims to temper this trend, prevent a potential bond bubble, and stabilize the market. This decision is notable given that central banks typically buy bonds during economic downturns to inject liquidity into the market. For example, during the 2008 financial crisis, the US Federal Reserve employed this strategy extensively. The People's Bank of China itself recently pledged to maintain a, quote, moderately loose monetary policy, end quote, to support growth. We covered this at the time, but we also warned that the monetary policy was already incredibly loose and that something like this may actually happen. This abrupt shift has puzzled some observers, including Mark Wu of Harvard, who today called it a mixed signal. However, Peking University professor of finance Michael Pettis explained in an observation yesterday that this should have been foreseeable, explaining, quote, China does not need more stimulus, nor even more monetary easing to boost inflation and raise bond prices, nor is that what the bond markets are saying. On the contrary, a quick glance at the debt numbers shows that China has plenty of both, and rather than raise prices, years of more fiscal stimulus and greater monetary easing have in fact accommodated a weakening consumption share of GDP, bigger than ever trade surpluses and disinflation. That's because, contrary to the implicit assumptions of most analysts, the Chinese monetary and fiscal systems do not operate like those in the US or the EU. While the US and the EU fiscal and monetary expansion tends to be directed to the demand side of the economy, in China, like in Japan in the 1980s and 1990s, it is almost wholly directed to the supply side of the economy. More fiscal stimulus and monetary easing, in other words, will not raise the domestic demand share of GDP, nor will they raise inflation and bond yields. In fact, they may just make matters worse. What China needs is not even more of the same, but rather a transformation of the way fiscal stimulus and monetary easing is directed into the economy. That is much easier said than done, of course, but until it happens, very little will change. End quotes. The move from the People's Bank of China yesterday also aims to stabilize the currency, which is depreciated against the dollar due to interest rate differentials, encouraging currency outflows. Now, despite these efforts yesterday, China's stock markets reacted negatively, with major indexes declining further. The CSI 300, for example, is down 5% year to date. Now, I often get complaints that this channel focuses too much on negative stories and as such isn't balanced. However, I reject this argument. The poor state of the economy is the story at the moment and will likely continue to be in the coming months at least. And yes, we can touch on bright spots like EV production and export numbers, and we will. But the fact of the matter is, at the moment at least, China's economy is in a very dire state, and that is the story that we need to follow. I would rather be accurate while appearing unbalanced than appearing balanced while being inaccurate. Now, before I move to the final part of today's episode, I wanted to share something personal with you all. For those who are not interested, you can jump to part 3 of the video. It should be on the timeline below. Click that and you'll be able to skip all of this. But for everyone else, I just wanted to share a couple of things. Regular viewers will know that I almost never share personal things about myself with you. You're here to learn about China and to try and understand China, not to hear about my life. But it's the weekend and it's a special day, so I hope you will forgive this indulgence on this occasion. Today is my birthday, and on my birthday I normally like to look back at the year, reflect on the year ahead, and also take the opportunity to reflect on what I'm grateful for. I'm grateful for many things, and one of the things I realized today is I am deeply grateful that I can work on this channel every day. It is something I really enjoy doing, and to be able to do this and share it with you all is a tremendous pleasure for which I am deeply grateful. The channel has grown rapidly in the last few weeks, and it does look like in the coming weeks, or perhaps this month, the channel will hit 100,000 subscribers. I started this channel almost 5 years ago as a hobby that I wanted to share, and I thought if it could get to 100 subscribers, that would be pretty amazing. The idea that I could soon be at 100,000 subscribers is something that I am still getting to grips with. Regular viewers will know that in the last month or so, I've moved to a format where the title and thumbnails are a little bit more provocative. I was very hesitant to make this transition. The YouTube platform unfortunately demands it, but it does seem like it has meant that this channel has been shown to many new viewers. In fact, there are viewers now probably watching this that have only joined in the last few days. This is probably only due to the YouTube algorithm reacting to the high click-through rates and showing these to new people. While it's regrettable that on this platform creators have to do this, as I've said before, no matter what happens, the videos themselves will continue to remain grounded and sober. As I've said in the past, if I get to 100,000 subscribers, I think this would be safe enough for me to move to doing this channel full time. This means that it looks like this year, 2025, will be the year when this happens. The idea that I will be able to do as my full-time job something that I really enjoy, that I really love, and that I can share it with so many of you is a dream come true. So, long story short, on my birthday today, I want to express to you, the China Update audience, both long-term regular viewers as well as newer viewers who may have joined in the last few weeks, thank you. Thank you for supporting me over this time. Thank you for allowing me to do this channel every day. Thank you for allowing me, perhaps this year, to do this as my main job. Thank you for joining me on this journey to understand this consequential and complex nation. Thank you. Now, let's continue with today's video. Next up, we move to the ongoing US-China technology war and specifically the AI race. US-based Bloomberg reports that the US will imminently announce an, quote, expansion of semiconductor trade restrictions to most of the world. The regulations would create 3 tiers of chip curbs. At the top level, a small number of US allies would maintain essentially unmitigated access to American chips. A group of adversaries, meanwhile, would be effectively blocked from importing the semiconductors, and the vast majority of the world would face limits on the total computing power that can go to one country. The third most restrictive tier affects China, Macau, and all countries for which the US maintains an arms embargo. End quote. As of the writing of this video, these rules have not been released, but they may be out by the time this video has been uploaded. Otherwise, according to the article at least, they will come out in the next few days. Beijing obviously is not happy with this development. However, US big business isn't too pleased either. As the US-based Wall Street Journal writes this week, quote, tensions between national security hawks and the biggest American technology companies over China policy has burst out into the open. The gloves come off this week because of anticipation that the Commerce Department would immediately introduce a global export license regime for graphics processing units, the type of chip critical to AI applications, and set sales caps for certain countries. The goal would be to close off loopholes that otherwise could allow China to access AI chips by tapping data centers in regions such as Southeast Asia and the Middle East. End quote. Oracle Executive Vice President Ken Glueck, in a blog post, called the new rules, quote, the mother of all regulations, end quote, adding that it, quote, does more to achieve extreme regulatory overreach than protect US interests, end quote. Even before the public clash this week, tensions had bubbled beneath the surface. Weeks after the first round of US export controls, NVIDIA released new chips for the Chinese market that were modified so that they didn't require a US export license. A year later, the US updated its controls and NVIDIA updated its China chips so that they again would avoid the export ban. In December of 2023, Commerce Secretary Gina Raimondo expressed frustration at dealing with what she described as industry resistance to export controls, expressing, quote, they're in the business of making money. Every time I take an action, it denies them revenue. We have to have our eyes wide open about the threat from China and work together, end quote. Meanwhile, some US analysts argue that China is advancing in AI despite US chip restrictions. In November of 2024, Alibaba and Chinese AI developer DeepSeek released reasoning models that, by some measures, rival OpenAI's O1 preview. The same month, Chinese video game juggernaut Tencent, which was recently labeled by the Pentagon as having military connections, unveiled Hunyuan Large, an open source model that the company's testing found outperformed top open source models developed in the United States across several benchmarks. Then, in the final days of 2024, DeepSeek released DeepSeek V3, which now ranks highest among open-source AI on a popular online leaderboard and holds its own against top-performing closed systems from OpenAI and Anthropic. Lennart Hem, a lead on AI and compute at the Rand Corporation's Technology and Security Policy Center, expressed this week, quote, we had a year where China could just buy chips which are basically as good as the most advanced ones, end quote. He explained that loopholes in US export restrictions in the past, coupled with the time for new chips to find their way into AI developers' infrastructure, is why, quote, we are yet to see the export controls have a full impact on China's AI development, end quote. Meanwhile, Japan-based Financial media outlet Nikkei Asia reports this week that China is gaining on the US in AI research, with Tsinghua University in Beijing chasing Google. Quote, of the 50 institutions with the most accepted papers last year, 14,766 authors hailed from the United States, more than any other country. China came in second with 8,491, with an eightfold surge over the past 4 years. 6 of the top 10 institutions are based in the US, including Google, which ranked first, Stanford University, Microsoft, and Meta. While Chinese players rounded out the list, Tsinghua University ranked second, and Peking University came in sixth. End quote. Meanwhile, while we're on this theme of US technology curbs, in recent days, US Commerce Secretary Raimondo told UK-based Reuters that the final rules for connected vehicles targeting China will be done next week, just before the Biden administration leaves office, expressing to the outlet, quote, it's really important because we don't want 2 million Chinese cars on the road and then realize we have a threat, end quote. In September, the department proposed prohibiting key Chinese software and hardware in connected vehicles on American roads due to national security concerns. That move would effectively bar Chinese cars and trucks from the US market. Major global automakers would have to remove key Chinese software and hardware from these vehicles sold in the US in the years ahead. The White House cleared the final rule last Tuesday, according to a government website. Veteran China analyst Bill Bishop observed on this development yesterday, quote, the hacking and the malware in key US infrastructure helped garner support inside the US government for these rules, end quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Saturday, have a restful weekend, and I will see you all on Monday. We covered this at the time, but we also warned that there was only so much it could